As we look out in the market today, we see there a need, especially with people getting close to retirement, for a product that delivers stable income in a low yielding world. So we think that the case for global high yield fits that. You know, the market we invest in is over 2.7 trillion in market value, over 1,500 companies globally, and you have the opportunity to invest in the debt of a lot of companies that people recognize, names like a Netflix or a Chrysler or Dell. And so we think that that opportunity set's very powerful for investors, especially now. One of the most important rules is avoiding companies with deteriorating fundamentals. The way you could lose money in this type of strategy is if you start having names where their fundamentals deteriorate and the company goes bankrupt. Now, we mitigate that by having a large research team dedicated to this strategy, over 50 investment professionals who their jobs are to really understand the drivers of each company and to get us out of the name before trouble occurs. It's what I mentioned before. It's really that bankruptcy risk. You know, on average, a recovery for a high yield bond is about 20 cents on the dollar. So what you want is to be proactive and to get out of names well ahead of times before they may default. I say, look, the market has evolved over the last 20 years. And so what has been a much smaller market 20 years ago that was basically in the US has evolved into a market where it's almost 2.7 trillion of value, 1,500 individual names, and a median revenue of over $6 billion. A lot of these are household names that people have heard of, whether it be a Virgin Media, a Chrysler, or a Netflix, but there are also business models that people understand, like a wireless telecom company or a cable company. Overall, it's pretty good. When I look at the three major regions that we're invested in, first, on the US side, I'd say business is booming there. You know, our companies are a bit more insulated from trade. Almost 80% of their revenue is generated in the US. And overall, they're still seeing good underlying demand in the US as unemployment is quite low and the consumer is actually very strong. When we move over to Europe, you know, while economic growth has slowed down there, a lot of that is more export related. Internal demand in Europe is actually still quite good. And the benefits of lower energy prices are starting to come through in Europe, and you're starting to see economic growth scrape along the bottom, and we expect that to improve in the next 12 months. Emerging markets, it's a wider group of countries, as there's over 30 countries there. And I'd say some countries are doing a little bit better than others. I mean, you're starting to see growth slow down there, and again, a little bit more of that is trade related. But overall, we're still seeing good economic growth from our companies that we're invested in. We think over the next couple of years, at least, the global economy will still remain strong. And in that type of environment, high yield does quite well.